Hello, thank you for tuning in. Today we're going to try to answer all the questions about socially responsible investing that you were too afraid to ask. I am George Mitten, investment writer here at Nutmeg, and I'm here with James McManus. He's the chap on the screen right now, and he is our Chief Investment Officer. This is a special one-off webcast, and it's a slight departure from our previous ones. In it, I'm going to try to embody the voice of the customer and ask James the kinds of questions prospective customers usually ask us if they're considering choosing the socially responsible investment style with Nutmeg. If you have questions, you can pose them to us as we're going along, and someone from the investment team will try to answer them. Okay, so first thing to say, James absolutely is the right person to be answering these questions because he's a bit of a specialist when it comes to socially responsible investing, or SRI, and he was instrumental in putting together Nutmeg's SRI offering or product. So he's the right person for the job. So James, first question. Imagine I am a complete beginner to investing, someone who's never really invested before, but I've come to Nutmeg and I've read about socially responsible investing and I'm kind of interested in it. In simple, everyday language, can you tell me what is socially responsible investing?
Hi, George. Sure. So, fundamentally, socially responsible investing is really about distinguishing between companies or securities that are the leaders in their field when it comes to environmental, social, and governance considerations, and those that are the laggards. The principle being really that those companies and securities that are able to demonstrate greater consideration of their environment, greater consideration of the impact that they have on their workforce and on wider society, and also, how they conduct themselves are likely to be best placed to navigate the long-term changes that we as a society face. So socially responsible investing is a style of investment that is, known more broadly by many different phrases, each of which really focuses on a slightly different approach, but some of which most people will have been exposed to in one way or another. And those might be terms such as sustainable or ethical, or indeed responsible. And when we use the term socially responsible investing at Nutmeg, what we're referring to is investing in companies that do business in a fair and progressive way, and overweighting portfolios towards companies with strong sustainability profiles, whilst avoiding companies or securities that engage in controversial activities. And this is really an area that has been growing quite significantly in the past 15 years. As investors have increasingly begun to sort of consider non-financial factors in their analysis of companies and securities alongside the traditional financial metrics they've used. And some of this has been, in effect, due to stakeholder pressure, with many different industries being asked to sort of consider their wider role in society, following the number of different scandals we've seen, whether that's tax evasion, customer data leaks, environmental issues, or indeed some of the bribery scandals we've seen play out over the past decade or so. And much of the focus has really been generated through the availability of newer and more advanced data sets that can really inform investors' opinions of a business, how it sits within its competitive landscape, and also its future ability to operate stably, but also successfully. And most investors, have for a long time had a framework to incorporate some non-financial factors in their analysis. And I think the benefits of doing so are pretty well understood. For example, we can all understand that a company that pays its staff fairly, that invests in training, that has a management team aligned with the success of the business, that's a type of business that should be positioned to perform much better than one that doesn't have those attributes. So, the application of this concept isn't really new, but what is new and what is exciting is the detail and the accuracy of the insights that are now available in the non-financial data we have. And, put simply, we're now measuring many things that previously we didn't. And that means we're able to manage, or potentially try to manage, the effect of some of those factors. So it's no longer just about avoiding controversies. It's no longer just about not investing in those activities that are detrimental to the world from an environmental or social perspective. It's also about using new data, new insights to try and understand how the world will evolve, how society, will view and solve its future problems, and also how that's going to influence the investment landscape. So by using those insights, combining them again with the traditional investment metrics, we hope to deliver an investment portfolio that better aligns with the interests and the values of our customers.
Right, so you use some terms there. ESG, environmental, social and governance is one that you've mentioned. You mentioned earlier also that there are a number of other labels out there in the market. Ethical investing is one, sustainable investing is another, responsible investing, as we said. Can you give us a sort of sense of what these labels actually mean? I mean, am I, for example, right, James, in thinking that environmental, social and governance, or ESG, means basically the same thing as SRI? Is that fair to say?
Well, I think you touched on a great point, and that is that it is, or it can be incredibly confusing when you look at the sheer number of different labels that are used to describe different approaches in the area of responsible investing. Many of which will share very similar characteristics and can be quite difficult to tell apart with a limited knowledge base as you first sort of come across this topic. And in fact, when I first started looking at this sector, it was also something I personally found very frustrating and very confusing, and that's actually one of the reasons we chose to do something about it at Nutmeg. And I think the first place to start here is to be really clear on what you're trying to achieve and how you're going to achieve it. And that's why we define what we mean by a socially responsible focus at Nutmeg. So, for us, a socially responsible focus, the focus that our socially responsible portfolios have, this is a portfolio that is actively managed and it has a view to investing in companies that do business in a fair and progressive way. What do we mean by that? How are we going to actually do it? What we mean is that these portfolios are going to overweight towards companies that have made a greater commitment towards social responsibility and away from controversial activities. I think the second part is really showing what you've achieved. And it was, it's truly astonishing to me when I first started to look at the sort of responsible investment sector that very few, if any, funds available really demonstrated what they've achieved through their methodology. That is that there were plenty of promises, but there was very little meat on the bone to assess what had been actually achieved by those promises. And we came across, mutual funds in the UK, those labeled sustainable or ethically focused, that in fact had, for example, a higher carbon intensity than the overall FTSE All-Share Index. Is that aligned?
How would something like that happen? That seems so contrary to what you would expect. Do you have an idea about how that would come about?
Well, I think it's about understanding how a methodology is being applied to a universe of securities. So, for example, somebody who could be looking at an entirely different area to environmental under social or governance may make the call to select companies on that basis. But I would argue that the outcomes are probably not entirely aligned to what underlying investors are always expecting. With our portfolios, we want to change that. We wanted to provide some concrete metrics that really allowed investors to understand, why the portfolios were different and exactly what was different about them. How they compared from an environmental, a social, and a governance perspective to existing portfolios, with a view that would really empower decision making and allow an assessment of whether they did truly do what they had promised to do. And that's why we now provide 10 metrics, 10 ESG metrics, as we call them, for all of our portfolios, not just our socially responsible portfolios, so that you can compare between them. And that really allows you to understand not just the intention of what the socially responsible portfolios are doing, but also the outcome. And that's really critical to empowering the right decision making.
Right, and that makes a lot of sense. And you've made the point there that data is really the key to all of this, not only in terms of the data that you guys use when you're making your investment decisions, but also the data, as you said, that you sort of pass on in terms of the ESG or the SRI score that customers can see when they log in and look at their Nutmeg portfolio. So clearly there's tons of data out there, all of the different companies that are reporting on these SRI metrics. That data has to be analyzed, it has to be put in spreadsheets and all the rest of it. we at Nutmeg, and I don't think you'll be offended if I say your investment team is relatively small compared with some of the biggest investment companies out there, and that's partly by design because Nutmeg is a sort of efficient, largely online business. But can you explain a bit about how your team of 7, I think, handle the load of analysing all of this data, and how you can manage to analyse so many different things and incorporate them in the SRI portfolios?
Well, that's a fair point, and you're exactly right. In the small investment team in Nutmeg, what we actually focus on is asset allocation rather than stock selection. So, we're focused on those big, broader decisions around investment portfolios. For example, should we own US companies over Japanese companies, rather than the minutiae of detail that's going on in every single underlying companies. And so what we do for our ESG framework is we leverage data from MSCI. Now, MSCI is one of the world's largest financial data companies, and they will have one of the most established research frameworks in the industry for environmental, social, and governance analysis. And they're assessing companies across the globe, across a range of key ESG metrics, each of which is going to then incorporate numerous pieces of data within it. So, for example, within MSCI's framework, they actually identify 37 different key areas under the environmental, social, and governance pillars. But actually, each of these areas will then have multiple pieces of data feeding it. So, for example, one of those key 37 issues is human capital, and that's an issue that will then incorporate lots of pieces of data relating to various areas that sit under human capital characteristics. So, for example, how a company manages its labor, how it develops its human capital, the health and safety standards it adheres to, and for example, things like its supply chain and labor standards. So, by accessing this research, we're accessing the resources of around 300 plus experts globally who truly are experts in their field. It's these same experts who determine the holdings in the majority of our ETFs. And so by utilizing that same research, we're able to better understand our portfolios, but also much better explain and articulate them to our customers. And those analysts at MSCI cover thousands of companies all over the world, as well as governments. And that means that even though we focus on diversifying our portfolios as much as possible, we're still able to obtain data across publicly listed companies, across bond and stock markets, and also obtain ratings for governments. So much like the ETF methodologies, this is a rules-based methodology. So it's very clear and consistent to see how it's applied across different geographies and across different asset classes. Having that access to the MSCI platform is incredibly powerful, and that allows us to drill down into the detail, to access full company analysis, to really allow us to better understand individual ratings, for example, how an individual company has arrived at the rating it's been given, or how in fact the ratings are constructed in the first place, as well as some broader thematic themes that run alongside environmental, social, and governance aspects. So, this isn't a portal we use just for our socially responsible portfolios. This is a resource that all of our portfolios benefit from, as we use the research to help deeper inform our investment practices more broadly when it comes to ESG considerations.
Okay, great. So MSCI, who is in this case Nutmeg's information provider, there are some other providers in the market doing a similar thing. MSCI, I think, is the biggest, aren't they, James, in this? So they really do a lot of the grunt work, if you like, analysing that data. But then we, as a buyer of that data, are the ones kind of putting that into practice with our investments, as I understand it. Okay, so James, you've given me a very, as always, very kind of thorough overview of how it all works, how the data works, what you do with the data. Let's say I'm thinking to myself, that all sounds pretty good. Okay, I'm tempted now to open my account with Nutmeg with the SRI style, but I still have some concerns, and those concerns might be, well, or okay, I want to do good with my money. I want my investments to align with my values, but let's say the money I'm investing with you is also going to be my pension, and I need to retire on that money. And in order to have the kind of retirement that I want to have, I need to achieve, a reasonable investment return over the next 20 years. So can you reassure me that by choosing SRI, that won't mean that I'm accepting less money in my pension pot than if I'd chosen a different investment style?
So this is a really popular topic, and it's an area we get a lot of engagement on. And I think it's not surprising that people often assume there's a trade-off here between being more responsible and then the returns you generate from being more responsible. And if we trace this back, this is really due to the fact that initially responsible investment was very, very philanthropic in nature. It was a very charitable exercise, and it came hand in hand with the style of ethical investing that potentially it wasn't as returns focused as it was focused on philanthropic means. And I think also this can feed from the fact that in the past some styles of responsible investment, some types of ethical investments have tended to be quite esoteric, and therefore they've also tended to be quite risky as well. But I think rather than just assuming that incorporating these factors into an investment process is going to lead to low returns, I think that actually there is an increasing body of evidence that socially responsible investing could in fact actually lead to higher returns. And the premise is simple, that companies, as we talked about earlier, that are best placed to operate successfully in the future are those that are going to have strong socially responsible profiles, those that do business in a fair and progressive way, with management teams that are addressing the short-term risk, but also ensuring the company's position to adapt to, the big long-term transformational changes that we face as a society, changes such as climate change. And our own performance analysis has shown that there have been no meaningful, statistically reliable differences in the performance of strategies that incorporate an SRI focus and those that don't. Our studies there use the same established SRI investment strategies that underpin the SRI focused ETFs that are in our portfolios. I would say, a lack of meaningful long-term differences in return doesn't mean that we always expect the returns of SRI indices and their non-SRI equivalents to be the same in the short term. In fact, we expect there to be some pretty big short-term deviations in performance depending on the stage of the economic cycle or the type of market conditions we're experiencing. For example, the SRI Emerging Markets Index has tended to have structurally lower allocations to China than its non-SRI equivalent. And if you think about the performance deviation that may then cause in the short term, but between the two, when the Chinese equity market either experiences strong gains or losses, you'll see how SRI and non-SRI equivalents could quickly see some short-term performance dispersion. But I think it's also worth acknowledging that most indices incorporating an SRI focus don't have the same history as their equivalent non-SRI market indices. So many have only existed since around 2007. So our studies of performance have some limitation in time, but we believe this time frame is long enough to be reliable. It incorporates over 10 years of history, and it includes the period of the global financial crisis. So overall, we expect our SRI portfolios to deliver performance over the long term that is equivalent to that of a similar portfolio without an SRI focus. That is, by incorporating a socially responsible focus, we don't think there is going to be a performance trade-off for investors. Of course, there is a marginally higher cost of underlying fund fees for socially responsible portfolios, and that will slightly drag on returns. But we think that the evidence that we've analysed suggests that there shouldn't be a long-term trade-off for investors here.
So if I've understood you correctly, James, there will be periods when SRI does better than conventional portfolios. There will presumably be periods where SRI may not do as well as conventional portfolios, but you expect that over the long term, those differences to iron out, and you think that SRI will do just as well as any other portfolio and possibly better.
That's broadly correct.
Okay, thanks, James. So you've told a good story there about performance, and let's say that we're convinced and we don't expect there's going to be a performance trade-off, as you say. Why, for example, don't you use SRI in the other investment styles, for instance, the fully managed style?
Well, the answer here is that we do utilize these funds in our fully managed portfolios as well. In fact, we strongly believe that ESG should be a consideration when investing, and we're working really hard to incorporate ESG considerations in our wider investment process at Nutmeg. In fact, we currently hold around 15% of all of our stock market exposure in fully managed portfolios in ESG-focused strategies, which is partly a reflection in our belief in that methodology, but also partly a preference that we have to lower the carbon intensity of our portfolios in the medium term. Why isn't every investment an SRI investment? Well, I think not every type of asset class is available in ESG form as yet, but as new products develop and product development in this space evolves, it's likely we'll see many more asset classes become available for socially responsible portfolios. And it's therefore, it's also very likely you'll see many more of these ESG focused approaches to different asset classes in our wider portfolios. I do think there's a balance here for us as investors to manage other risks as well. And for example, many newer funds or strategies can be very small. Our fully managed portfolios now manage over £1.5 billion for UK investors. And that means we can't simply go and buy a big allocation of a fund. We need to exercise some risk management in our ownership of strategies too. But as those new strategies grow, we are able to consider them for a much wider range of portfolios at Nutmeg. And actually, one of the things that we do is work as closely as we can with ETF providers to ensure that we're getting the right products built in the marketplace. So if you're invested in our SRI portfolios, for example, you might have recently noticed we started to include very short-term corporate bonds. That's an area we've worked with ETF providers to influence product launches and make sure there has been something developed and available in that asset class. And we also hope to have other asset classes, those such as sterling corporate bonds in the coming months. And we're providing feedback on a number of other potential options and potential asset classes for those portfolios at the moment.
Okay, thanks, James. Now let's go into a bit more detail and find out how these kinds of portfolios really work. Now, I understand that if you have an SRI portfolio, you expect certain polluting industries or certain very sort of controversial types of business to be excluded. You would expect that you wouldn't invest in everything. You will have a smaller pool of investments because you are being more conscious with your investments. So tell me, what does Nutmeg exclude and why?
Yeah, that's right. So I guess the starting point is that our socially responsible portfolios follow the same actively managed approach to asset allocation as our fully managed portfolios. And that means that our investment team will actively change the mix of the assets in the portfolio over time based on their analysis of the prevailing economic environment. And within our SRI portfolios, we then use funds that have a explicit social responsibility focus alongside holdings of government bond strategies that help us retain the diversification benefits within portfolios. And this allows us to really improve the ESG characteristics of an investment portfolio whilst ensuring it remains diversified and fit for purpose. So, what do we exclude and what do we include when it comes to the range of socially responsible strategies we use when constructing these portfolios? Well, at a minimum, what you can expect is that the following types of securities would be excluded from those funds that are held in those portfolios, and that is any securities that have significant exposure to the tobacco industry, whether that's as a producer or a distributor, any securities that have in any way any involvement in the production of nuclear weapons, and similarly any securities that are involved in the production of controversial weapons, and that's weapons such as landmines, cluster bombs, chemical and biological weapons. So at a bare minimum, securities that are involved in any of those industries will be excluded. But actually what you'll find is that many of the exclusions that are employed by the funds that we utilize in these portfolios have a much wider remit than that. And they also prohibit activities such as the production of alcohol, the production of adult entertainment, any companies that have significant involvement in either the gambling industry or the nuclear power industry, or any significant exposure to civilian firearms, for example, either as a producer or as a distributor of those. And then, of course, any companies that derive a significant revenue from activities involving thermal coal or genetic modification. And whilst we don't explicitly exclude companies that are involved in the fossil fuels industry at present, we've also listened really hard to what our customers want and expect from these portfolios. And we've engaged with the wider industry, with our peers, with the product providers, both from an index and an ETF perspective, to make sure that the products that we utilize in these portfolios achieve exactly what's expected from customers. And so from later this year, many of these products will also exclude companies that own fossil fuels reserves as well.
Right. Okay. So, you've touched on an important point there. You've listed several things, types of business, which many people will probably be quite happy to have excluded from their portfolios, like nuclear weapons as a perfect example. But, the fossil fuels answer there touches on the fact that these portfolios don't exclude everything, right? And so the energy sector is one that is often talked about. Can you tell us a little bit about that? Why, in what circumstances would you not exclude, for example, an energy company?
Well, as I just mentioned, many of these companies in the energy sector will now, or later this year, will be subject to further screens, which may result in them, failing to meet the standards that are required for entry, if you like. But I think it's really worth touching on, why some of these companies are included in the first place. And remember, the objective here when building these portfolios is still to retain core investment principles such as diversification and strong liquidity attributes, but to do so in a way that exhibits much greater responsibility and alignment to ESG principles. And so firstly, the MSCI ratings, the research ratings that drive the selection of those companies, they take into account thousands of data points across those 37 key issues that I mentioned earlier. And they really focus on the sort of intersection between a company's core business and the industry issues that can really create significant risks and opportunities for the company. And these ratings are constructed using both qualitative and quantitative research. So using the full breadth of those 300 plus experts in their team. But I think it's really important to know that the approach that these products are employing is to firstly screen out the organizations that are involved in these undesirable activities or have been involved in major controversies, and then allocate to the highest scoring or best in class organizations that are left in that remaining pool. And this really achieves two things. Firstly, companies engaged in controversial activities are avoided. But then secondly, those that have strong sustainability profiles relative to their industry peers are then rewarded. And that really encourages better behavior. So the second part of this process is really important because you're choosing to allocate capital to those that are leaders in the sector. You're encouraging better standards. Those companies that aren't allocated to, those companies without access to capital, therefore have to improve their standards in order to compete. And it also means that in industries such as fossil fuels, you also remain able to influence the behavior of the best-in-class businesses by remaining an active stakeholder. So, core to the design when we were building these portfolios was to ensure they remained suitable to meet our clients' long-term investment goals. And as such, diversification really remains critically important. And this requires continued engagement in the broad sectors of the global economy, of which, a sector like oil and gas is included. And the methodology employed really means that where we do take exposure to industries and sectors that could be deemed unfavorable, we're doing it in those companies that are considered best in class. So if you have to own an oil company to maintain diversification, we want to be owning those oil companies that lead their industry when it comes to ESG considerations.
Right. Okay. So there's obviously some subtleties involved here. You kind of mentioned there how not every oil and gas company is equal, and you might find some of those energy firms running their business in a much more responsible way than others, for example. And I suppose the challenge really here is, how do you assess some very large companies which may have quite a lot of different business lines, and they may score well on perhaps on some issues, they may score poorly on other issues. So can you tell me a bit more about that, how you kind of balance these different considerations, because some of these firms really are quite complex, aren't they?
Yeah, that's exactly right. And companies aren't simply rated based on just one aspect of their operations. They're rated on their overall performance against a broad range of criteria, and then also relative to the other companies in their industry, their peers. So they're really how they are assessed. How companies are assessed under this methodology is adjusted for how material certain risks are within an industry. So to give you an example there, carbon emissions and pollution is likely to be much more important when you're assessing oil companies than it is when you're assessing technology companies, for example. But to think about it another way, data privacy and taxation is probably a more relevant consideration in technology companies than it is in oil companies. So the research really focuses on what's material within a given industry, whilst also looking at how different companies compare to each other within that industry. And both the screens and the assessments that are made here can throw up some really surprising results. Tesco, for example, is excluded from our socially responsible portfolios at present because it generates more than 5% of its revenue from tobacco products. That's despite the fact that it's actually a relatively good performer in many other areas of ESG assessment. So it's really a broad assessment that has a focus on critical issues, and that's what's really helped this methodology avoid so many of the most controversial corporate issues in the past decade. And I think it's worth using an example here to bring this to light. So one example would be Pacific Gas and Electric, which was one of the largest energy companies in the US. It employed around 20,000 people, and it was responsible for delivering energy services to about 16 million people in California. And that company filed for bankruptcy last year after some of its equipment was deemed to have started one of the most destructive wildfires we've ever seen in Californian history. And by many financial metrics, PG&E would have appeared in relatively good shape prior to that event. But ESG research really highlighted several risks that were specific to the company within its industry when it was assessed against its peers. And in particular, MSCI here noted that the company was subject to much more significant biodiversity and land use risks relative to its peers, because all of its operations were concentrated in very high wildfire risk areas. And also California was the only state in the US where electricity companies can be held liable for wildfires. So very different profile to that of its peers in terms of its environmental risk. But critically, the research also noted that there were previous reports from the California Fire and Forestry Department, and that demonstrated a real gap between the promises the company was making in terms of its maintenance of equipment and vegetation, and how it was actually executing that strategy. So in simple terms, the research was flagging that the company had a track record of not meeting its safety requirements relative to its peers, and it operated in a really high risk area. And actually what we saw there was, in the end, some equipment being responsible for a wildfire, and the cost of which was so high that the company actually had to file for bankruptcy in the end. So ESG research has been really effective in flagging some of these risks that are not immediately apparent in the financial metrics, but actually are intra-industry risks. So looking at a company relative to its peers and identifying, where it's really a leader and where it's really a laggard.
That's an interesting example. Thank you, James. And I think a lot of people will be quite impressed by that example, and the ability of some of these metrics to predict or perhaps to screen out some companies like that which are sort of headed for disaster. So I mean, it all sounds, of course, James, you're a real proponent of SRI. You believe in it. We run a lot of money in SRI portfolios here in Nutmeg. So of course you're an enthusiast. But there must be some drawbacks, right? I mean, you know, there's no free lunch in investing. You know, there are cons as well as pros. Can you tell me what are the drawbacks with SRI? You know, I've been told, for instance, about concentration risk, for example. Perhaps you can tell me a bit about that. Tell me tell me a bit more about those sort of higher fund costs. It's not because I, you know, as a potential customer, don't want to invest in SRI. It's just that I want to know exactly what I'm getting into, both positive and negative.
Sure. Well, I think we've already talked about the fact that we expect there to be short-term performance deviations from a traditional sort of market cap, size-based, weighted strategy over time. Although we don't expect there to be, you know, any meaningful long-term differences in performance and risk reward. But it's certainly true there's a much smaller range of asset classes available in ESG form. I'm not always sure though that means greater concentration risks. You know, one of the core attributes of these portfolios is still to focus on diversification, and that you know, is a core principle that is no less true in the way that we manage these portfolios. And you know, clearly there are going to be less underlying holdings. There are going to be less underlying securities because you're screening out some of the companies and you're removing those that fail to meet the highest standards. But we still think we're able to offer really diversified exposure to global stocks, for example. We have companies that are listed across 23 developed and 26 emerging markets, as well as government bond exposure the world over, including in emerging markets. So, you know, when we look at the universe of assets that's available to us in socially responsible form, it's still one that we think offers, you know, a globally diverse base of investments for a portfolio. And I think also when we look at performance, you know, thinking about risk, you know, because of the way that these products are structured, because they participate in all the sectors of the global economy, you know, they limit their differences in terms of sector and country differences to the main market indices. We don't see a significantly higher risk profile. And in fact, in some markets, SRI investing has actually demonstrated lower risk in terms of volatility. So yes, they are more concentrated, you know, because you've removed some companies and then you're weighting towards only the higher scoring companies. But does that present more risk? Not necessarily so in the long term, because of the way that the portfolios have still been structured to focus on diversification, and because of the way that the underlying ETFs have been structured to minimize the differences between sectors and country weights.
Okay, all right. You know, let's say I'm convinced, almost convinced. I'm thinking, okay, you know, you've told me a very good story. I like the sound of Nutmeg's SRI offering, and you know, and I'm interested. Final question would be, why Nutmeg? I suppose you know, we've mentioned that other investment firms offer socially responsible type services, responsible investing, ethical investing, and so on. You know, we've heard that it's a growing trend. That would, you know, imply to me that you know, more investment companies in future are going to offer these kinds of services. Why Nutmeg?
Well, I mean, hopefully some of what we've already talked about today goes a long way to helping convince you that, you know, our approach is well considered, that it's rooted in leveraging the same core investment principles that we focus on in every one of our portfolios. And that is not trading off against those core investment principles, that we think it's wise to stick to over the long term. And that it's also an approach that's informed by you know, a huge amount of data that's been synthesized and provided in products in a really intuitive way. But I guess if I had to summarize, I think I'd focus on three things, and they would be consistency, transparency, and limited trade-offs. So, you know, consistency, I think, is really key when it comes to investing in a socially responsible way. And I think many strategies may seem to be very sensible on a standalone basis in terms of what they're trying to achieve, but the difficulty really comes when you start to combine them. And we know that diversification is a key route to managing risk, and this most often involves a multi-asset approach, and that's what we focus on at Nutmeg. We offer you know, three different distinct types of multi-asset approach to investing, and when we talk about single asset class strategies. So, for example, just in equities or just in bonds. These have often been built with sort of an individual philosophy and an eye, without an eye to how they fit in that wider portfolio context. And so, as a standalone strategy, it can make a lot of sense. But combined all of a sudden with other strategies into a multi-asset approach, your total portfolio that's needed to get you to your investment goals, all of a sudden they start to display contrasting or conflicting approaches. So, our approach is rules-based. ETFs are always rules-based. They have a rules-based methodology underneath that governs exactly how they select securities and exactly how they apply those screens across a range of different markets and across a range of different assets. And that really helps create consistency across the portfolio. And that means you may not always agree entirely with the methodology itself, but you can't disagree that it isn't consistent over time. And I think that's a really important aspect to focus on. The second point I mentioned there is transparency, and I really think we offer unrivaled transparency when it comes to helping you decide whether these portfolios are right for you. So we led the industry in reporting ESG metrics to our customers for all of their investment portfolios. We've done that since late 2018. And we also worked with our customers to really understand, what you wanted to know about your portfolio in order to feel empowered to make the decision here. And again, you might not always agree with every single underlying holding in the portfolio, but you will be quickly able to understand the bigger impact your investments are having in a socially responsible portfolio without having to worry about every single underlying holding. So you no longer need to worry about whether the reality holds up to the marketing story here. We're going to provide you with concrete metrics that demonstrate to you, how your portfolio compares from an environmental perspective, a social perspective, and a governance perspective relative to portfolios that don't apply the socially responsible approach. And then the final third item there I mentioned was limited trade-offs. And this is really core to our offering. We allow you to better align your investments with your personal values, to reduce your carbon intensity of your investments with little overall trade-off. So we don't believe over the longer term that there will be a performance detriment to investing responsibly. We also believe we're able to offer an approach here to responsible investing that doesn't trade off against those core investment principles such as diversification or low costs in order to be more responsible. Yes, there is a slightly higher fund cost associated with these portfolios, but it is relatively small. And I think it represents really good value given the vast quantities of data that are going into determining the allocations and the fact that since their inception, these portfolios and these products have more than recouped that additional cost. So, they would be my three reasons to choose a Nutmeg socially responsible portfolio: consistency, transparency, and the fact that we believe we're able to offer an approach that really has limited trade-offs versus our existing approaches.
Okay, James, thank you. Very thorough as always, and I think you've given a really good overview of Nutmeg and socially responsible investing in general. So I hope for those of you who have been watching or listening, I hope that was informative. If you would like any more detail on this topic, why not check out our blog, Nutmegonomics. It's got lots of blog posts on there. James has written many of them, talking about some of the issues he's discussed today and going into a little bit more detail on some of the more technical discussions. If you don't find the answer that you're looking for there, then why not contact our friendly customer support team? They'd be delighted to help. Or alternatively, leave us a message in the comments section below. Thank you very much for watching. See you next time.